Welcome, everybody, and thank you for joining us today for the Q2 Economic Update. I'm Sean Patton, Champion Partner of CNC Financial Group. As your trusted tax and financial advisors, our team is always available to answer your phone calls, emails, and questions. So please don't hesitate to contact us with anything you need about your account. Our focus on tax efficiency as part of your overall financial plan is why we always have a CPA and a full-time financial advisor in the room. Although we are tax focused, our process always begins with a holistic approach based on our review of the personal financial planning needs unique to you and your family. The more we understand your vision and goals, the better we can help you prioritize and realize meaningful progress. One of the ways we assist in delivering tax efficiency is investing through our partnership with Russell Investments in Seattle. We have collaborated with them on a number of specific portfolio designs and value our partnership with their team. They are kind enough to offer our tax and financial services client this quarterly economic update. Mark Eibel couldn't join us today. However, Dan Hodo, Inland Northwest Regional Director with Russell Investments, is prepared to back him up, and we are looking forward to his presentation. Dan, we appreciate you filling in on short notice, and we're ready when you are.
Awesome. All right, let me share my screen here, make sure that that's all working. Are you able to see my screen?
We can.
Okay, awesome. All right, well, I'll go ahead and jump in here. And yeah, we'll be talking a little bit about our outlook as we move forward, and also a bit of a review. That's just kind of the reality of the time of the year that we're at, right? It's a good chance to do a mid-year review of how things have worked so far and also where things are headed. We'll definitely touch on the election as things have changed a little bit there just in the last couple of days. So we'll talk through the election and how that can impact and affect the markets. But yeah, appreciate you all joining us, and Jason, Sean, and your entire team. Appreciate the great partnership with your firm. So let's go ahead and dive in. The first thing I wanted to cover, again, this is a little bit of a review, and this is kind of a busy slide, but it gives us some reasons to be optimistic as we head really into the second half of the year. So if you notice where 2024 is located, it's in a column where it's showing that the return in the first half of the year was between 5 and 10%. And we're looking specifically at a balanced portfolio, 60% stocks, 40% bonds. And the reason we use a balanced 60-40 portfolio is because that's where a lot of people that are either in or close to retirement tend to gravitate. So it's kind of a good way to look at, okay, how's a well-built, diversified portfolio performing? And we see that in the first half of this year, a balanced portfolio gave you a return between 5 and 10%. And also it gives us all the other years in the last 40 years where you've gotten between a 5 and 10% return from a balanced portfolio in the first half. And I think a lot of people will think, okay, well, we had a good start to the year. Most likely the second half of the year isn't going to be as strong. We're probably going to have a pullback. There's probably going to be some punishment for having such a good start. But if we look at this graph, we see that that's really not the case. If you look at the far right 3 columns on here, these are every year where we've had a 5% or greater return in the first half. And if the number is listed in green, that means the second half of the year was also positive. If the number is listed in red, that means the second half of the year was negative. Well, out of the 20 years that we're looking at there, only one time did you have a negative return in the second half of the year. And that was 1987. And a lot of you might or might not remember this, but in 1987, we had Black Monday on October 19th of that year. The market was down 22% in a single day. That's the one outlier. Every other time that we've had a return from a balanced portfolio of 5% or greater in the first half of the year, we've also had a positive return in the second half of the year. So that's 95% of the time. That's how things play out. So again, if you have a strong start, usually you have a strong finish as well. So that's one reason in our minds to be optimistic as we move forward. traditionally, if the market starts well, it finishes well also. So that's where we're at so far this year. Taking a look at what worked and what didn't work, the top row is going to tell us just kind of how the second quarter performed for the different asset classes. The bottom will show the year-to-date returns, so the first 2 quarters. And you'll see that most asset classes have been positive. The ones that haven't performed as well, the ones that are negative for the year, are bonds, municipal bonds, and global real estate. And those 3 things all have one thing in common. They're all very sensitive to interest rate moves. And we've had a lot of interest rate moves this year and really over the last 2.5 years. So I know a lot of people will look at their bonds right now and go, bonds have been so disappointing. Is this still an area that we want in a portfolio? The one thing I would say to that, or a couple things I'll say to that, but first is a diversified portfolio, for it to work, you need things to zig when others are zagging. And quite frankly, if everything's working, it probably means you're not very well diversified. So it's okay that a couple of things are underperforming or disappointing at one given time. Ultimately, your portfolios are up. Regardless of how you're diversified, you're positive this year. That's the reality of so many asset classes are doing well. But some reasons to be optimistic as it relates to U.S. bonds and municipals is where we're at in the interest rate cycle. Like I said, the last 2.5 years have been really painful. Interest rates have been going up. The Federal Reserve has been raising rates. It's important to remember how bonds work as it relates to interest rates. So as rates go up, bond prices go down. So that's why it's been so painful the last 2.5 years, because interest rates have gone up so far and so fast. The Federal Reserve has been very aggressive in raising rates. But now we're at a different point in the cycle. Now the Fed has paused, right? And at some point in time, they're going to lower rates. Same thing, when rates go down, your bond prices will go up. So I almost look at this, so the easiest way to look at all of this, and probably the simplest analogy that I can give you on the opportunity with bonds as we move forward, is it's almost like we've been climbing a mountain, okay? So over the last 2.5 years, we've been doing all the hard work. We've been climbing the mountain, taking a step at a time, right? Interest rates have been going down or up. Bond prices have been going down. You've been losing money in bonds. It's been frustrating. That's been us climbing the mountain for the last 2.5 years. But now we're at a different point. Now we're at the summit, right? Think about climbing a mountain. You're tired from getting up to the summit. What are you going to do? You're probably going to rest, have some snacks, enjoy the view, right? You're going to kind of get your wits about you a little bit. Well, that's where we're at in the interest rate cycle. And what I mean by that is that rest and that enjoy the view is right now with bonds, you're getting a really nice income, probably about 5% income or yield from your bonds. The Fed has paused, so interest rates really aren't going up or down. So this is the chance just to enjoy the view, to collect the income on your bonds while we wait. But pretty soon, the Fed's going to lower rates. That's when you have a chance to make some really good returns in your bonds. That's when we're going to have the easy part ahead of us. We're going to be walking down the mountain. We think that probably happens sometime in the next 6 months or so, where they start to lower interest rates. You're going to get your income from bonds, but you're going to get appreciation as well. We think there's an opportunity over the next 12 to 18 months to be earning double-digit returns from bonds. So they've been disappointing. We've been doing the hard work. We've been climbing the mountain. We're at the top. Collect your income while we wait. When interest rates go down, we're going to be going down the other side of the mountain, and that's when you're going to get paid. So hopefully you can kind of visualize that analogy, but bonds, while they've been disappointing, are about to be something that we get rewarded for sticking with. Real estate, I'd say, is pretty similar as well. Lots of pressure on the real estate market globally when rates are high. When interest rates come down, you see a lot more activity, and typically you see real estate prices increase. So those couple areas have been disappointing, are also some of the areas to be most optimistic about as we move forward. Now, one thing that's really interesting is as we look at the market, we've been in an environment without a lot of volatility. And with such a kind of polarizing election coming up, I think a lot of people would have expected this to be a year with a lot of volatility, a lot of big swings in the market. In an average year, you get 72 days where the market is either up more than 1% or down more than 1%. So far, we've had 20. So we're very light on volatility, yet the market's up double digits, over 15% in the first half of the year, and we've even built on that so far in July. 2023 was similar as well. Not a lot of volatility, yet you got a 26% return. So I'd say it's almost been like this Goldilocks scenario where not too hot, not too cold. You're actually getting paid to be an investor. You're getting really compelling returns without a lot of volatility. So technically, people should be sleeping well at night, right? Should be feeling really good about being investors, yet most people that we talk to, we ask them, how do they feel about the market? How do they feel about the economy? Most people will tell you they don't feel great. They're actually pretty pessimistic about things, yet there's a disconnect there because the market's been doing great, not very volatile, yet investors don't feel super great. One way to look at this is when we look at our economic indicators dashboard, the very bottom example that we're going to look at, it says consumer sentiment. Consumer sentiment is how we all feel. And the University of Michigan has a great index that tracks whether we're optimistic or pessimistic. You can see that we're outside of the typical range, which is 90% of the time we fall within the typical range. You can see that right now, the indicator is to the left of typical, meaning that we're extremely, as consumers, we're extremely pessimistic. Not very often are we outside of that typical range, but right now, the average person, the average consumer is feeling very pessimistic. And it's interesting because, again, the market's performed really well. And in fact, so far this year, the market has hit a new all-time high 31 times. So we've got a market that just continues to climb with almost no volatility. If you ask most people that own a home and they look at their home value, it's probably at or near an all-time high as well. So on paper, we're doing pretty well, right? Our accounts are up, probably at or near their all-time highs. Our home values are at or near all-time highs. So on paper, we're doing really well, but most people don't feel great. They're actually pretty pessimistic. I think there's a couple of factors there. One is the election. It's got a lot of people anxious and nervous because we know it's polarizing and it's going to be close, right? So regardless of what side you're on, you probably don't have tons of confidence, right? So there's that part of it. There's the inflation piece. Inflation is low and it's in the typical range. It's at about 3.25 right now. Yet the stuff that we have to buy every week, food and gas, those prices are still elevated. They're still pretty high. So it's something that we have to buy every single week, every one of us, and it's elevated. So we've got kind of that pressure and that frustration of elevated gas and food prices. We've got the election that's kind of overhanging. And I think those are the two big drivers for why people aren't ultra or real optimistic about the future. But once again, the economy actually is fairly strong. Housing values are strong. The market has reached 31 new highs without a lot of volatility. So there is a disconnect somewhere, but a lot of that, I think, again, has to do with the inflation and with where the election's at. Now, one of the things, kind of switching gears, that we get a lot of questions on is where's the opportunity in the market? I already talked about bonds. We see a lot of opportunity with bonds as we move out over the next kind of 6 to 18 months. Another area, though, is small cap stocks. Small cap stocks have underperformed large cap stocks, like the S&P 500, for the last really 12 years. It's been an extended period of time where small cap has underperformed. Typically, small cap stocks do really well in a strong economy with low interest rates. Small companies have to borrow more than large companies to fund their operations, to fund their growth. When interest rates are elevated and high, like they've been for a while now, it puts more pressure on small cap stocks. Those are typically environments that they underperform. We think small cap, as the economy gets stronger and as interest rates get cut, we think small cap will be one of the best performers of the market. So something to keep an eye on. One thing that's kind of interesting as well, it's been the best performing area of the market in July. Small cap stocks just in July are up 7%. So we think there's a lot more opportunity as we move forward, especially when the Fed starts to cut interest rates. So we do see opportunity out there. And actually from some of the areas that have been more disappointing lately, we think those are some of the best areas of opportunity once interest rates start to go down. Okay, let's talk just a little bit about the election, and then we'll kind of wrap up. Obviously, a lot going on with the election. A new candidate on the Democrat side. You know, I think a lot of people would expect with a new candidate, with that type of uncertainty thrown in at this late in the game, that the market wouldn't respond very well. But sure enough, you know, that happened over the weekend. Yesterday was a really good day in the market. Today, when I looked right before this meeting, the market was up. You know, the market actually has responded and performed really well in the face of change and adversity. And one thing that's kind of interesting, if we look back throughout history, we'll see that election years have historically been really good years to be invested. So we're looking at the last really 90 years, and we're looking at every election year since 1932, and we wanted to see how does a 60-40 diversified portfolio perform in an election year. And if you look at the very bottom left, you'll see that in the last 23 election years, 20 of those times a 60-40 finished with a positive return. And the average return from that balanced 60-40 portfolio was 8.5%, which I would think most of us on here would probably say, hey, I'll take an 8.5% return from my diversified portfolio. I'll take that any year, let alone an election year. And if we look above and we can see election year by election year, what did the 60-40 do? And most of these returns are pretty solid. You end up with 1940, which was one of the negative years, one of the 3 negative years, down 4%. One thing I think most people could handle is a down 4% with a 60-40. And then we look at the context. It was the beginning of World War II and the tail end of the Great Depression. I would say the down 4% had a lot more to do about World War II than it did the election, right? And then you have to fast forward 60 years before you got another negative return during an election year. That was 2000. I know that was a really close election with Bush and Gore, and we had recounts, we had the hanging chads, right? But again, the downturn, which was only down 1% for a 60-40, again, I think we could all handle that. That downturn had a lot more to do about Y2K and the beginning of the tech bubble than it did the election. And then we get 2008. That's the really painful one. That was the Obama-McCain election. Again, though, I think that downturn had a lot more to do about the global financial crisis, banks failing, people losing their homes, all the subprime debt issues. So the 3 downturns coincided with 3 significant historical macro events. A lot more to do about those events than those specific elections. So outside of those 3 big macro events, typically you invest in an election year and you do pretty darn well. So why has this year been so strong, right? Why was last year so strong? Doesn't the market know that there's a big, important, contentious election coming? Yes, it does. But the market historically does really well in election years. So what we're seeing so far this year to us isn't a real big surprise. Barring some big macro event, we think there's still a lot of reasons to be optimistic as we move forward in this year and even get closer to the election and beyond. Last slide that I wanted to share. This looks at the last 50 years, and we're kind of having fun with all of this election and politics stuff here. So in the last 50 years, if the AFC conference won the Super Bowl, then you get a 17% return. If the NFC, so the Seahawks, if they were to win the Super Bowl, you'd get a 16% return. So I guess it was good news that the Chiefs won because that's their AFC. That's good for the market. Even or odd calendar years. I wish it was an odd year, because in an odd year, you get double the return that you get from an even year. So that's kind of going against us this year. Groundhog results. This really matters if the groundhog sees its shadow or not. So good news, this year the groundhog did not see its shadow. So that's a good thing for the market. If you get a Republican or Democrat in the White House, over the last 50 years, it didn't matter. You got a 16% return either way. So I know we're kind of being silly here about it, maybe being a little bit flippant about politics. I don't want to downplay it, right? Politics matter. This election matters. Policy matters. All of those things matter. But the impact that the president has on the market is a lot less than I think what people would think. And the impact that an election year has on the market is a lot less than what people would think. So kind of joking around a little bit, but maybe we all should be focusing a little bit more on the groundhog and whether or not it sees its shadow, and worry a little bit less about the election. Probably not, right? Obviously, again, it's important. But we do like to remind everybody that let's not mix our planning with our politics, right? Politics matter, but those two things shouldn't be interfered. We shouldn't mix our planning with our politics. And typically, one thing that we'll see happen is people will get frustrated if their candidate doesn't win, and they'll want to get out of the market, right? The one thing that we can control is, hey, if my candidate doesn't win, everything's going down, I want out of the market. Well, historically, the market just moves on without you, right? And so again, don't mix your planning with your politics. Politics matter, but let's not let those decisions or those choices influence how we're going to invest and stay invested or not. So with that, those are kind of the main slides that we wanted to cover today. Definitely some reasons to be optimistic as we move forward. The economy is strong, inflation is moving in the right direction, interest rates probably in the next 6 months are going to start to go down, which creates some economic growth. It makes borrowing easier. That makes things better for corporations, especially on the small cap side, and it means that we can get rewarded for owning those bonds that have disappointed us for a while. You can start to get some pretty good, compelling returns. But while we wait for rates to come down, if you're a bond investor, you're getting that income, you're getting paid to wait. So with that, Jason, Sean, I can pause. Are there questions there from the group or questions that you have for me that I can help with?
Thanks, Dan. Appreciate it. At this time, I don't see any questions in the Q&A. I would open it up for everybody online to, if you have any questions, go ahead and type those in the chat feature there at the bottom of your screen, and yeah, take advantage of Dan's willingness to answer some questions.
Especially last minute, we really appreciate you filling in, Dan. Just amazing how many all-time highs we've hit, this far in the year, 31. I can't believe that. I hadn't heard that stat yet, so that's pretty incredible.
Yeah, it's definitely one of those things, we watch the news, we read the news, and that's not one of those things that's been talked about. And yeah, it is pretty staggering number just to see the market kind of consistently day after day building on itself. And even when I talked about the volatility, only 20 days plus or minus 1%. Well, most of those have been plus 1%. So they're volatile in a good way, right? We're getting a 1% or greater return in a single day. So the volatility that we've had is working in our favor. And yeah, 31 new market highs is pretty compelling.
All right, Dan, we do have a question for you regarding housing. And
Okay.
Would it be a good idea to invest in bare land for future building?
Well, I mean, it's an interesting question. Land isn't going away, and being somebody that lives in the Pacific Northwest, seems like there's less and less of it available. So it probably always has been a good investment, as you look over time. But it is an interesting time as it relates to interest rates. We would expect more building. we would expect more buying and more just general activity as rates start to come down. That's typically what you would see. I'd say right now you have a lot of people just kind of waiting things out. If you're looking to buy that new home, when you've got 7% plus 30-year interest rates, it's just a kind of a staggering number. And so I'd say there's a lot of money on the sidelines waiting to get involved and waiting to participate and waiting to buy homes once interest rates get to something that's a little bit more compelling. So yeah, I mean, if you've got the means, it's probably not a bad place to be looking. And that's the real estate market in general, recognizing that there will be a lot more activity once rates come down.
Thanks, Dan. I've received notification that the chat feature is disabled, but the Q&A, the question and answer, the feature is certainly working. We're getting several messages, several thanking you for speaking for us today, Dan.
Oh, good. Yeah. Hopefully it was helpful. You know, again, it's pretty easy to do a review when pretty much everything's working and all of our accounts are up, right? But as we move forward, again, still see lots of opportunity out there. And you know, again, really appreciate the partnership and always happy to jump in and do this. I know Mark Eibel's the kind of the A team, and we'll have him on the next quarter. Just ended up with a conflict at the last second that we couldn't avoid there, but happy to jump in.
Yep, great. Thanks, Dan. To everybody online, thank you for joining us today. We certainly appreciate the trust you place in our firm, and we look forward to seeing you at your next review meeting. And certainly don't hesitate to call us if you ever have questions and there's anything we could do for you. Everybody enjoy the rest of your afternoon.
Have a great day, everyone. We'll see you.
Thanks, everybody.